Good morning, everyone. Good morning, distinguished speakers, colleagues, and participants. My name is Mauricio Vanderlei, and I'm Brazilian Director on the United Nations Board of Auditors. It's a pleasure to welcome you to this webinar on IPSAS 48, and I would like to begin by expressing our sincere appreciation to our distinguished speakers from UN Women, UNDP, and the IPSAS board. We are very grateful for your availability and your willingness to share your knowledge and perspectives with us. I would also like to warmly welcome all participants. We are pleased to see colleagues from Supreme Audit institutions engaged in the audit of United Nations entities, as well as UN accounting professionals and other interested colleagues. As many know, the panel of external audits of the United Nations plays an important role in promoting cooperation, knowledge sharing, and consistency across the UN system. At the panel's last meeting held in November here in New York, members recognized the significance of the new revenue and transfer expense standards and agreed to establish two dedicated working groups, one on IPSAS 47, coordinated by Switzerland, and another on IPSAS 48, coordinated by Brazil. The purpose is clear: to provide a space for auditors across the UN system to exchange views, discuss practical challenges, and explore possible interpretations. This initiative reflects an important understanding. The implementation of new standards raises conceptual and operational questions, particularly in the UN environment, where transactions are often complex and diverse. To support this effort, we are strengthening our communication with the UN Task Force on Accounting Standards, including its leadership and technical experts. This webinar is part of that broader effort. It's an opportunity to deepen our understanding of IPSAS 48 and to foster a productive dialogue among users. Thank you all once again for being with us today. It's now my pleasure to give the floor to my colleague Tiago Dutra, who will coordinate this webinar. Tiago, the floor is yours.
Thank you, Mauricio. Good morning, everyone, all colleagues, speakers, participants. We are pleased to host this webinar today as part of the coordination of the Working Group on Standards for Transfer Expenses. IPSAS 48 is a new standard and, as expected, raises important questions for accountants and auditors. This is especially true for the United Nations system, where transactions and arrangements can be quite complex. And that's why today's discussion is so valuable. We have the opportunity to hear directly from professionals who are closely involved in the development, interpretation, and application of the standard. And before we begin, I would like to thank the members of the working group for their support and participation, especially Martin from Switzerland, Michel Camoin from France, Stefan from Germany, Uttar from Indonesia. And now, let me briefly explain how the webinar will work. We will begin with a 25-minute presentation by Aileen and Edwin from the IPSAS board staff. Aileen is a principal at the IPSAS board and has been involved in a number of important technical projects and strategic initiatives. Edwin is also a principal at the IPSAS board and has worked extensively on projects related to transfer expenses and other key public sector accounting topics. In this first session, they will walk us through the main concepts of IPSAS 48 and the key accounting decisions and approaches introduced by the standard. After that, we will move to a second 25-minute presentation by Johanna Clark, Catherine Mully. Johanna is currently Vice Chair of the UN Task Force on Accounting Standards and an experienced financial management manager in the UN system. She currently leads the financial division at UN Women. Catherine is also an experienced financial manager in the UN system. She's currently at the UNEP and brings to us guidance and operational process involving transfer expenses. In this second session, they will help us reflect on how IPSAS 48 can be applied in the UN environment and why this standard is especially relevant in practice for all organizations. After these two presentations, we will have around 1 hour for questions and answers. Our idea today is to have a light, open, and practical conversation among professionals involved in preparing and auditing financial statements. Many of us are looking at the same challenges, which is how to understand and apply these new concepts in a complex environment such as the UN system. So please feel free to raise your hand and share your thoughts, comments, and questions during the Q&A session. You can also use the chat to write questions and observations during the webinar. We will gather some questions at a time, rounds, and I hope we have a productive discussion today. I'm also joined today by 3 colleagues from the Brazilian audit team who will help me consolidate the questions and direct them to our guest speakers, Heitor, Henrique Carneiro, and Henrique Napoleão. So once again, thank you all very much for joining us. We are very glad to have this opportunity to discuss IPSAS 48 with colleagues who have first-hand knowledge of the standard and its practical implications. With that, let us begin with Eileen and Edwin. Thank you so much for being here. Please, the floor is yours.
Good morning and bom dia. Thank you so much for the opportunity to join your workshop today. As Tiago mentioned, my name is Eileen Zhou, and with me is my colleague Edwin Ng. We are both principals on the staff team that supports the IPSASB on financial reporting projects, and notably, we are also the leads of IPSAS 47 and 48. We collaborated quite closely as the IPSASB was developing these two standards to be consistent in principle. So we really appreciate this opportunity today to engage with you directly and to share an overview of IPSAS 48, its key concepts and requirements. And with that, I'm going to pass it to Edwin for the official presentation on IPSAS 48.
Thank you, Eileen. So we have a lot of material to cover, and I realize we only have 20 minutes, but so I'll try to be quick. But in terms of IPSAS 48, so this standard on transfer expenses, this was developed with revenue, as Eileen just said. And in terms of what actually goes into this standard, it's really expense transactions that meet the definition of a transfer expense. So what that means is in 48, we define a transfer expense as any expense other than taxes where the reporting entity is providing a good service or other asset to another entity without directly receiving anything in return. So that could apply to things like grants, contributions, or even if you're giving away capital contributions. So you're giving away grants to build a capital asset or giving away a capital asset itself. The key is that you're not getting anything in return, so it's a non-exchange transaction. The standard has some scope exclusions. I've listed some of the ones on this slide. The one thing I will touch upon is where it says contributions to owners. Owners in this case is not meant to be limited to a specific person. It could also be a controlling entity. So it could apply to the UN if there are inter-entity transactions where you're essentially giving away assets to an entity that is controlling a subsidiary. So on this slide, I'll quickly go over some examples of what could be or would not be in scope. And as a reminder, the expense transaction has to meet all the characteristics of a transfer expense to be within scope. So in the first scenario, we have cash transfers to implementing partners to construct a school for a local government. And after that construction is done, the school is controlled by the local government. So essentially, you're giving away money for the government to own the school. So in this case, the transaction is within the scope of IPSAS 48 because the government retains control of the capital asset or the school and is not giving anything back to the UN in return for these funds. For the second example here, we have cash used to acquire equipment and supplies for own use. And because you're getting the equipment or supplies back, that essentially is an exchange transaction. So that would not fall into the scope of IPSAS 48. For the next example here, we have grants paid to university to conduct research. And the university controls the research findings. And they actually explicitly said that they're going to release the findings publicly. Now, this might sound like the contributor, so the UN is getting something back in return. But because the research findings are released publicly and essentially everyone has access to these findings, the research findings are not an asset of the UN. So essentially, you are not getting anything in return in this scenario. So because of that, this is also in the scope of IPSAS 48. And then the final scenario here is income taxes paid to governments. And on the previous slide, I said income taxes were specifically excluded. So because of that, this scenario is not within the scope of IPSAS 48. Okay, so in terms of the overall structure of IPSAS 48, the standard is really split up into two parts. So once you have a transaction where you know your transfer expense and you're looking into how to account for this transfer expense within IPSAS 48, the key question is really whether this expense arises from a binding arrangement. And I'll start going through what is really a binding arrangement because this is really key to how to account for a transfer expense under the standard. Okay. So for some of you who have worked on IPSAS 47, you might see or you might be familiar with this concept because the concept of binding arrangement and enforceability, as we'll get into soon, is the same across the two standards. And binding arrangement in this context is essentially an arrangement that confers both rights and obligations to the two parties. And these rights and obligations are enforceable through legal or equivalent means. And it's important to keep in mind that you have to have an arrangement with both rights and obligations, and these have to be enforceable by the two parties in the arrangement. So you could have scenarios where, for example, you have a government imposing an obligation on an entity, but the government is not obligated to do anything in return. In that case, it would not be a binding arrangement. And we'll go through some examples in a bit. But before we get to the examples, we talked about enforceability on the prior slide. And in 48, we specifically say that a binding arrangement has to be enforceable by legal or equivalent means. And what that essentially means is you have to have terms within the arrangement where the two parties can hold each other accountable. And by legal means, we're talking about things like judicial rulings, case law precedent, and whereas equivalent means could be means outside the legal system. So it could be something like a statutory mechanism, so executive orders from a government or ministerial directives. So for the UN, we would expect that the UN wouldn't be the party who are executing or coming up with executive orders, but they could be subjected to an executive order if you are dealing with a government as a counterparty. Okay, so as I said before, enforceability is really talking about having the ability to hold the other party accountable in fulfilling their responsibilities. So both parties have to be able to exercise these rights. And essentially, in the context of transfer expenses, a transfer, a resource provider needs to have the right to hold the resource recipient accountable and use the resources in the manner specified in the contract. And for the resource recipient, if they have performed under the contract, they need to have the right to be able to compel or hold the transfer provider accountable to provide these resources. And in terms of enforcement mechanisms, it could be explicitly stated in the binding arrangement, or it could be implicit. So it could also be driven by um, terms of the arrangement and also facts and circumstances, such as jurisdictional or customary practices. Okay, so this slide is really an overview. I'm not going to talk to it because we're going to talk about the two slides or the two sides in detail coming up. But as I said before, once you're in the scope of IPSAS 48, the key question you have to ask yourself is, does this expense arise from a binding arrangement? And generally, if you have a transaction without a binding arrangement, the accounting is going to be a lot simpler than a transaction where the expense does come from a binding arrangement. But before we get to that, we'll have a quick two examples on enforceability. So in this case, you have two entities, entity A and entity B. Entity B is requires entity A to use the funds that they're provided to deliver education programs to a region. Entity A must use the funds, and if they misuse the funds or if there are any funds left over, then it has to be provided back to entity B. So essentially, any leftover funds have to be refunded. But in this scenario, entity B does not always provide the funding amounts, and if it comes down to it, entity A does not really have any right to compel entity B to provide the full amount. So even if entity B, even if entity A has started providing education services, if entity B doesn't deliver on its funds, there's really nothing in the arrangement that lets entity B go back to them and say, well, we need the money, so can you give it to us? So because there is no right on both sides, this is not a binding arrangement, because even if the educational services are provided, the party has no right to essentially go to the transfer provider and ask for funds. Okay. In the second example, we have two entities R and P, and P is providing entity R with 6 million over 3 years, and the funds are used specifically to provide sanitation services over the 3-year period. So entity R is required to provide quarterly reporting on how the funds are being used, and essentially they have to be used to provide these sanitation services, or they have to be returned. And entity P is contracted to pay these funds over the 3-year period, beginning from when the agreement has been signed. So in this case, in this case, both entities R and P have rights and obligations in this arrangement. So entity R is obligated to provide the sanitation services and has a right to compel payment according to the arrangement. And entity P is obligated to pay and has the right to essentially compel entity R to perform these services, or they will have to return the money. And because there are rights and obligations on both sides with both parties, this is a binding arrangement. Okay. So now that we've walked through what is a binding arrangement, the first step is, or the next section, we're going to look at transactions that do not involve a binding arrangement because the accounting is relatively simple. So most of the time, when you're giving away resources in a transaction without a binding arrangement, you derecognize the resources when you have lost control of those assets. Essentially, what you would do is you would record an expense, and then you would credit the assets that you've given away and essentially write those off your balance sheet. There could be situations, however, where an entity created a legal or constructive obligation to give away resources. So in this case, IPSAS 48 would actually direct you to go to IPSAS 19, which is the standard on provisions, contingent liabilities, and contingent assets. And in that case, if you do have a provision set up, you would essentially debit, or you would recognize an expense and a provision. And then when the actual transfer of resources occurs, you would draw down the provision that you've set up. Next, we would go to the other side of the branch that we've looked at. So in terms of transfer expenses from transactions with binding arrangements, the accounting is more complex, as I've said. But essentially what happens is, because these are executory contracts, meaning that nothing really occurs from an accounting perspective right when you sign the contract. And the accounting is really driven by whether any of the parties to arrangement have started to fulfill that arrangement. So in terms of what happens if the transfer provider has started giving away resources, you would essentially have a transfer right. So that is the right to enforce the other party to satisfy the obligations in the binding arrangement, or face the consequences for not fulfilling their obligations. Or you could have the flip side, where the transfer recipient performs first, and as the entity providing the resources, if the counterparty has provided first, then you would now have the obligation to transfer resources in the manner that is specified by the binding arrangement. Typically, when you look at the accounting for transfer expenses, each transfer right and each transfer obligation is a unit of account, and we will go through some examples to explain what that really means. For most arrangements, most transfers are typically not just a one-off transfer. It could be transferring a bundle of assets or goods or services. So before we look at the actual debits and credits, it is important to look at the components of this binding arrangement and look at what transfer rights are actually in this agreement. So essentially, it's from the transfer provider's perspective, you're really thinking about what are you paying for. So you're giving away assets, goods, or services. What do you expect to get, or what do you expect the other party to deliver for these goods and services that you're giving away? So in IPSAS 48, there isn't really as robust guidance as in IPSAS 47, because the underlying concept is really that when you're negotiating a transaction or a transfer, you're going in knowing that you're giving away a set or a bundle of assets, and you know what you want to get out of giving those things away. So what the guidance does is you have to think about the arrangement and identify all transfer rights, and then you have to identify the rights that can be enforced separately from the other rights. So, for example, if you have a bunch of assets that you're transferring at the same time, and it's their use is really being monitored uh, in one manner, so achieving the same objective, then all those assets are really used to fulfill the same goal, and there is no real way to objectively enforce their use individually. So in that case, you would actually bundle them all together, and you would treat them all as one transfer right. Okay, so now that we have the underlying concepts out of the way, so there could be two scenarios in expense with binding arrangements. The first is if you, as the transfer provider, performs first, i.e., you're the one who first transfers the assets to the transfer recipient. Then in this case, what happens in terms of the detailed accounting is you would de-recognize the asset that you transferred, and you would recognize a transfer right asset. Now, this transfer right asset is really an embodiment of the fact that you, as the transfer provider, has the right to direct the use of these resources, and essentially how the transfer recipient is to go about using these resources. And in most cases, if they do not use it in accordance with the binding arrangement, there should be, or there most of the time, there is some sort of clawback or penalty mechanism to make sure that you can compel them to use these resources appropriately. So in IPSAS 48, we refer to these assets as transfer right assets, but we also say in the standard that you could really call them using alternative descriptions, and the term transfer right asset doesn't have to be used. So what we've actually seen in practice is a lot of governments have called these prepaid transfers just to, it's very similar to prepaid expenses, but in this case, you're not really getting anything in return. So they specifically call them out as prepaid transfers. So after the initial transfer, you would have this transfer right asset on your balance sheet, and you would have gotten rid of your the assets that you've transferred. So what happens is now you have to look at whether this right has been extinguished, and usually these transfer rights are extinguished as the counterparty starts fulfilling their end of the transfer arrangement. So, as the counterparty starts performing, you would essentially write down this transfer right asset, and you would uh, debit them as a transfer expense. And there could be some other scenarios where the transfer right asset is should be written down, so it doesn't always have to line up with performance. Sometimes the counterparty could, or sometimes they don't have the ability to fulfill the binding arrangement anymore. Essentially, they're defaulting on the arrangement. And in that case, if you have went through the enforcement mechanisms and determined that there is no way for them to pay you back, essentially you have an impairment and you would have to write off this transfer right asset. The other scenario is if the transfer recipient, so if the counterparty in your scenario performs first. So what happens is we have already seen, or in some cases where, for example, you're providing funds for the counterparty to, let's say, perform sanitation services. If they could prove to you that they have already performed these services, then the binding arrangement usually would obligate you to transfer funds. So in this case, if the transfer recipient performs first, what you would do is you would recognize a transfer expense, and you would also recognize a transfer obligation liability. And this liability really represents the UN's obligations to transfer the expenses because they're now owed to the counterparty. Similar to transfer right asset, in IPSAS 48, we say that you don't have to use the term transfer obligation liability. And in practice, we have seen terms like transfers payable being used. It's really up to how you explain them in the notes to the financial statements. After setting up this initial liability, what happens is when or as you're transferring the assets that are in the binding arrangement or specified in the binding arrangement, you would draw down this liability and you would remove the assets from your balance sheet. So the example on the slide here, we say cash. So you would essentially credit the cash or the asset and you would debit the liability because you have already recognized the expense in the first step. Okay, so there could be scenarios where both parties are performing at the same time. Essentially, you would look at both arms of the transaction. So you look at how you as the transfer provider has performed and recognize a transfer right asset, and you would also look at how the transfer recipient has fulfilled their obligations to date, and you would recognize a transfer obligation liability. And because both the asset and the liability are coming from the same binding arrangement, you would actually net them on your balance sheet and they would show up as one number in the financial statements. Okay, so next we have measuring the extinguishment of a transfer right. So going back to a few slides, I've said before that as performance or as the recipient performs their obligations, you would essentially write down the transfer right asset. And what this is essentially talking about is how do you amortize your transfer right asset into an expense. And the way you would go about looking at that is you would look at the individual transfer rights and see if there is a way to value each of those transfer rights. So a lot of times, as I've said before, when you are negotiating a transfer agreement or an arrangement, you know exactly what you're giving away and you know what you're trying to accomplish. So because of that, from the perspective of the transfer provider, we don't think this will be a complex issue like whereas if you think back to revenue, it could be hard to come up with compliance obligations because, you're really just essentially buying a bundle of goods from the counterparty. In this case, you're the one who specifies what you're giving away and what you want for these assets. So in a lot of cases, we expect there to be explicit standalone values for each asset that you're giving away within the binding arrangement. And IPSAS 48 says that if there are explicit standalone values, you would use those to value each of the assets that you're giving away in the arrangement. Whereas if there is no standalone value, you would essentially still look to your intention. So you would think about like what was your original intent when you're entering this agreement and how much were you thinking about paying for essentially the transfer recipient to how much are you planning to compensate them to perform whatever it is you want them to perform. And so a few reminders here. So this is really judgmental. The standard doesn't really have any hard and fast rules. It's really based on each arrangement and how you have negotiated your terms. And as I said before, it's really expected to be much more straightforward compared to a revenue analysis because it really depends on your intention as a transfer provider. So what are you really paying for and how much are you willing to pay? And there could be some situations where variable consideration is involved. And for variable consideration, we would expect that, the arrangement usually would specify whether these variable considerations are um, related to one specific transfer right. And if there is no specificity, then you would essentially proportionally allocate it to all transfer rights. So we have 3 quick examples based on some of the audit reports that we have looked at. And the first one is really a very simple base case. And in this example, it's a performance-based grant. And the entity, or let's say the UN, is entered into a grant agreement, and it's really based on performance-based payments. So the cash payments to the recipient are based on predetermined performance milestones. As they're being fulfilled, you would have to provide payment, and this fulfillment is confirmed by a third-party assessor. The first payment is actually made upon the signing of the agreement, but all subsequent payments would be based on achieving the milestones. The recipient's milestones in this case consist of providing services to third-party beneficiaries, and the agreement allows both parties to enforce the rights and obligations to hold each other accountable. So what is the accounting for this grant? Well, because this is a grant where you're essentially not getting anything in return, and you're holding each other accountable, this is within the scope of IPSAS 48, and it is a binding arrangement. So what happens is when you do the cash transfer, you would derecognize the cash, and you would recognize a transfer right asset. And subsequently, you would start to derecognize these transfer right assets as the recipient starts fulfilling its obligations. And as the recipient fulfills its obligations, you would also recognize a transfer right liability if you don't have an asset to draw down on. So essentially, this is most likely the most likely case where you would have a net balance that consists of both the transfer right asset and transfer obligation liability based on how both parties are performing in accordance with the agreement. Okay. In example 2, we have a transfer of supply inventories, and in this case, it's a program that's governed by a binding arrangement and involves transferring supplies to an implementing partner who then subsequently transfer these to the intended third-party beneficiaries. So the question in this case is, does the physical transfer itself result in a loss of control? And control in this case is really it's the ability to use or direct the resources that you're transferring. And IPSAS 48 is really only applicable to cases where as the transfer provider is losing control of the assets that are being transferred. So you could have a situation where you have given supplies or inventory to a implementing partner, but you could still retain control of these resources. And if that's the case, then that transfer is actually not within the scope of IPSAS 48. And from an accounting perspective, you actually don't really have an accounting event because all you're doing is moving inventory from one location to another, and it's still under your control. So you would still have the inventory on your balance sheet, and you would continue to account for it normally, meaning that you have to consider things like obsolescence risks and deterioration. And IPSAS 48 actually doesn't really talk about control in much detail, and it doesn't really even go into principal agency relationships in a lot of detail, because when we were developing the standard, it was really envisioned that you would have very straightforward cases where you would lose control when the assets are physically transferred away from you. But we realize that that is not always the case. So in cases where there is a potential for you to retain control, we would actually look to IPSAS 47 in revenue, where they provide considerations for whether the assets are still under your control. And in some cases, the implementing partner is really acting as your agent. And in that case, you would also look to IPSAS 47 to look at the considerations of whether there's a principal-agent relationship. And as I said before, if the implementing partner is your agent and you have transferred supplies to them, unlike revenue, where there is specific accounting for principal agency relationships, for transfer expenses, there is no accounting at all because you've actually still retained control of these resources and you really haven't have an expense, or you really don't have an expense. So nothing happens from an accounting perspective.
Edwin.
Yes. Yeah.
Yes. Sorry, apologies for the interruption.
Yeah.
But we have now reached the time for the session. May
okay.
I kindly ask you for just 2 minutes so that we can move to the next part? Thank you very much for your understanding.
Yeah. So yeah, I'm actually, this is my last example.
Oh,
so
great.
yeah.
Thank you.
Yeah. So in this example, it's a cash assistance program. So in this case, you are providing cash assistance, but the implementing partners have 3 months to present funding authorization certificates and to essentially prove that they're using the funds appropriately. So the fact pattern that we looked at was essentially only funds that were proven to be used appropriately up to year end were reflected in the financial statements. So the question is, when should the expense be recognized? And so having a confirmation mechanism is great, but then that doesn't really drive when your expenses should be recognized. Your expenses should be recognized as the recipient is fulfilling their obligations. So in this case, what should really be happening is even if the use of the funds has not been confirmed until after the year end, there should be some sort of adjusting entry to make sure that all the appropriate uses of funds are reflected in the financial statements. So that was the point that I wanted to convey in this example. Yeah, so I guess we'll have questions at the end. So I'll stop sharing my slides here and pass it on, I think, to Joanna.
Thank you so much, Edwin. It's a great, comprehensive presentation. We have a lot of details, and also we know that there is one big decision to make, if it is binding or not, and especially in the UN system, that's really tricky. And fortunately, we have here Johanna and Catherine to help us to go through the UN environment. Thank you so much, Admin and Aileen. Please keep up with us. At the end, we will have the Q&A session. Johanna and Catherine, thank you so much for being here with us. Please, the floor is yours.
Thank you so much, Tiago. And it's a hard act to follow coming in after Eileen and Edwin, who are the experts in this area. Those of you who don't know me, my name is Johanna Clark. I'm the Vice Chair of UN Task Force on Accounting Standard, and I'm the acting CFO for UN Women. Tiago, is your team going to share the slides, or should I?
Carol, can we share, or?
I can share it from my side if that's easy. I think I was told that the preference was for your team to do so, but I can I can do it from here as well.
Okay.
That's not a
Thank you so
problem.
much.
Hold on, I have it here. Just one moment. Right. I'm just checking if you can see my slides now.
Yeah.
Yes, we can.
Yeah, good. Thank you. I can no longer see anybody else. So if there's any issues, please just let me know, and I will answer or and make any comments from there on. So I'm not going to go into the technical details because Eileen and Edwin have covered those. So we are really focusing from in our presentation to application of those principles within the UN system, and focusing on at least partially on the issue of enforceability and whether we have a binding or without binding arrangements. So we have been working on the IPSAS 48 and 47 for a number of years now, and we have the preliminary reviews for IPSAS 48 already from back in 2023, and we are currently coming back to it now that we are looking to implement the standard in the UN system to refresh to see if everything still holds. Then we have when we have been starting to dwell into the more details. So we don't have a defined confirmed precision yet. So I'm today presenting the preliminary TFAS views, and obviously the discussion today may then contribute to the final decisions on that one. As I mentioned, the critical judgments include enforceability, determining whether the arrangement is binding or without binding arrangements, recognition of timing, treatment of goods, so inventory, and obligations under transfer arrangements. And our guidance, once it's been issued, is intended to promote consistent application across UN entities, ensure there's a comparability in our results when our users of the accounts, that is mostly the member states and key recipients of funding, that they know when they look at our financial statements from one entity to another, they represent similar information, of course, taking into account any unique circumstances of each entity's mandates. However, it's not mandatory, but we are encouraging UN system entities to apply where it's applicable. We are currently in the process of making sure that the original position assumptions still hold, as I mentioned, and preparing the documentation and fostering dialogue with all of you here today. So the purpose of the guidance, as I mentioned, is to help entities consistently recognize and de-recognize transfer expenses and ensure that they're supporting evidence for the audit evaluations. We are focusing on the transfer provider side of non-exchange transactions, including cash and non-cash transfers, such as inventory. I will move on to the enforceability side. Back in 2023, when we were working on the guidance initially, we had a survey across the UN system, and 25 UN system entities responded. And one of the questions we had is, what kind of a type of transfer expenses do we have in the UN system? Unfortunately, the results cut the name in the picture, but basically what we have is transfers of cash that are in scope of the harmonized approach to cash transfers. That's HACT. We have entities with cash transfers to implementing partners that aren't following HACT. There's 19 entities. We have inverted transfers in development context to implementing partners for onward distribution by others in 8 entities. We have implementation agreements of other types in 18 entities. We have cash transfers directly to beneficiaries in 18 entities, but I'm not. I think originally in 2023, this was just to capture the information. Don't think it necessarily fits the definition of transfer expense in all contexts, but it's useful information to have. Sometimes we have purchases of equipment and vehicle on behalf of implementing partners who then distribute it onwards. And then we have grants, and some entities have all of the above, and only one entity had none of the above, and hence didn't really have the transfer expenses in their scope. The other key questions that we had was around enforceability. We were trying to gauge whether we actually have enforceable mechanisms in the system and where those might exist. We are considering redoing the survey and seeing if there has been any changes in this area. But 7 entities reported that they have no enforcement mechanisms for the transfer recipients to enforce the contractual terms due to immunities and privileges in place. 3 entities weren't sure whether they had, they were still evaluating it. 5 reported that they have enforcement mechanisms in the legal agreements, but there's no examples of those clauses ever being exercised, so there was doubt whether those in substance are actually enforcement mechanisms. And 5 reported that there's UNICITRAL clauses, but no examples of actual use of the clause even in a dispute situation. And I think this is a common. We have not been able to find a single incident of UNICITRAL clauses either in revenue context or transfer expense context where the UNICITRAL mechanism of arbitration has actually been used. But like I said, this is a couple of years out of date, and we are likely to refresh these survey results to see if there has now been any actual enforcement mechanisms identified. In relation to whether we're talking about the two-way, as the transfer providers, do we have the ability to enforce the contractual terms of the transfer expenses? And 23 entities reported that yes, they can, and they have experience of doing so, and 2 entities reported that no, they cannot do so. And examples given as to how the enforcement has been evidenced is the successful return of funds from implementing partners when they have been used for purposes that were ineligible, withholding of future tranches of funding. There's audits that have been carried out and recoveries of funding as a result of the audits. But then there has also been, highlighted again that there's those arbitration and UNICITRAL causes, but actually no evidence of enforceability through those functions from our side either. So why is enforceability different in the UN system context? This is largely due to UN system only being subject to international laws. We normally, there's obviously can be some exceptions in some unique contexts and unique regulations of individual entities, but in general, UN system entities are only subject to international laws, not national laws. And I think Edwin mentioned an executive order of a government that would normally not apply to UN system entities, even if they are operating in that country, because of immunities and privileges that UN has in operating in that country, and there's separate agreements governing our activities in those countries. So there's a limited recourse through legal means, because of the immunities and privileges. And there's no known cases of enforcement through legal or arbitration, as I mentioned before. And I think one lawyer that I spoke to described it as that our agreements are legally binding under international law, but there's no enforcement mechanisms in place to actually, make sure that those clauses are followed through. But that doesn't mean that there aren't situations in unique entities. And hence, each entity has to have a look at their regulatory context to see if there's a difference or different in agreements. So, but we have found that one-way enforceability is in place, and we are demonstrably able to direct and control to protect the service potential and control resources after transfer. So For example, when we often advance cash to implementing partners, so we don't wait the implementing partner to do the work. In some cases, they do the work and then reclaim it, but much more common scenario is where we give cash in advance to an implementing partner, and they then implement afterwards. So we don't see always that we lose control when the resources has been transferred to the transfer recipient, because we know we can still control it and recover it if it's not being used in an appropriate manner. So hence our original position is that we treat those advances as advances on the balance sheet until the implementing partner has delivered what they should be delivering, and even though there isn't a two-way enforceability, we still do have an asset. And as I mentioned, there might be some exceptions in different entities. So our conclusion is that most UN arrangements lack two-way enforceability, so are treated as without binding, but there needs to be a review for exceptions in limited circumstances. Where the enforceable right exists, advances are recognized an asset, reflecting retained service potentials, and that's the example I just gave. In relation to inventory transfers, the guidance is saying that the expense is recognized when the control is lost. So, for example, if the inventory is stored in a third-party warehouse and we still control it and have the ability to recover it and benefit from the rights of ownership of the inventory, then the transfer expense is not yet recognized. But if the ownership has transferred to the implementing partner, or they effectively control and direct the use and distribution of the inventory without us being able to have recourse from issues, then the inventory is expensed when it's transferred to an implementing partner. So I think this is an area where the expense recognition for inventory might vary between entities depending on the contractual arrangements and enforcement mechanisms that they have in place. And then we have, sort of a decision model for the IPSAS 48, where we first do the assessment on whether there's a binding arrangement or without binding arrangement, enforcing the substance of those enforcement mechanisms. And then when we have without binding arrangements, we need to have a assessment whether we still have an asset recognition or an expense recognition. And as I mentioned, for the advances, there often is a case for us to be able to still control and recover if the funds haven't been used appropriately, and there is an asset. And the expense recognition is the step 3, when the enforceable rights are extinguished or control of resources is lost, and then we recognize the expense. So just to recap, we have grants and cash delivered to beneficiaries and similar transfers, and these ones depend on the individual contractual terms and the arrangement of the program. So if the grant-like transfer, it meets the example that Edwin provided, where we are giving a grant to a third party to do something that's then going to be available to everybody. It does fall into the scope of transfer expenses, but we don't really control or direct the use of the grant. So it might be that the expense point is at the time of the grant is being distributed. And the distribution of cash to individual beneficiaries, whether that's a transfer expense, depends on, again, in the nature of the arrangement. If we are going through a third party, for example, a financial institution who does the cash distribution, we have recourse if an enforcement mechanism. If they don't do that, then there might be might be a transfer expense even if there's no implementing partner involved, or if it's directly from us, then it might not be in scope of the transfer expenses standard. But there is, if there's no, any promises to deliver goods or services, then there's no prepayment or an asset, and it's expensed at the time it's distributed. Okay, we then have, considerations, of course, for the provisions. As Edwin mentioned, there might be, legal obligations, and if there's a constructive or legal obligation in place, and we need to provide provisions, those are under IPSAS 19, so we haven't really brought them in to the IPSAS 48 guidance because there shouldn't really be any change from that. IPSAS 19 has been in place for a while, and we continue to apply it. If there's no asset liability or expenses recognized, if there is a binding arrangement, then when it's wholly unsatisfied at the reporting date, there is no accounting happening. So there might be some instances where we have a binding arrangement, but the precision paper that guidance we have is then, emphasizing the IPSAS 48 requirements. And for the transfer of goods, as we mentioned, the expense point is when the transferring entity loses control of the assets, and we might need to look into the inventory standard for further guidance, as Edwin mentioned earlier. I think that's it from my side. I'll hand back over to Tiago so that we have time for discussion. Thank you so much.
Thank you, Johanna. Thank you very much to all speakers for these excellent presentations. Now we move to the Q&A session. As we've seen, IPSAS 48 brings important concepts and practical implications, and today's discussion has already helped clarify many relevant points in the UN system. This is intended to be a light and practical exchange, so please feel free to raise your hand, and if you would like to speak, I encourage all participants to participate, especially my colleagues from the working group, but all participants are invited to make questions and comments. We already have here some questions. I would like to invite our colleagues to raise their hands and speak if they are comfortable with. Maybe we could start with Cameron. Thank you so much for being here, Cameron. Great, you can see your hand here. Not sure if you are.
Okay. I've been unmuted. So morning, afternoon, everyone. Yeah, my question was just in the chat, and I think Jo addressed it in her presentation as well. It's when you've got non-binding arrangements and the potential to recognise an asset in that scenario where there's one-way enforceability, i.e. the transfer provider can enforce against the transfer recipient, but not the other way around, how that reconciles with slide 12 of the IPSAS board presentation, because that indicated loss of control equals expense, IPSAS 19 provision equals expense, but didn't cover off on that third scenario of the recognition of an asset. Thank you.
Thank you, Cameron. Maybe we could start with Eileen and Edwin.
I'll jump in. So yeah, exactly what Joanna said. There could be situations where you still have an asset. We don't explicitly cover it in transfer expenses or in 48 because in most cases, if you've transferred something but you still control that asset, then it's not really an expense. So that's why we left it out the authoritative guidance, and there's nothing explicit in the standard on that. But yeah.
I guess just a quick
Thank you.
follow-up if I can. The nature of the asset might change. So if you transfer, so if you have a binding arrangement, you may end up with a transfer right asset, which is effectively intangible, I guess, in nature. If you have a non-binding arrangement, you can have the same kind of situation where you're transferring something physical, but the nature of the asset is subject to that enforceable right could be different to what's actually being transferred. So I think for me, there's a little bit of an inconsistency here. So that hence the question. Because in your plain vanilla scenario where you're, for example, transferring cash or transferring inventories and you still control them, you wouldn't derecognize them off your books. But you may have a scenario where you fall within the IPSAS 48, but the nature of the asset is different. Thanks.
Yeah. So yeah, and that's in that case you would have a reclassification. Yeah.
Thank you, Edwin. Johanna and Catherine, would you like to comment?
No, nothing to add from our side, at least from me. But yeah, I see there's a few hands up. So in the interest of time, we can come back with the collective comments later. Thank you.
Okay, thank you. I see here Henrique. Henrique, please go ahead.
Thank you, Thiago. Just like to thank as well the IPSAS board and the task force for the really enlightening and helpful presentation, considering this is a really challenging framework to interpret. So many thanks for the presentation. I'll have a follow-up question mostly related towards the aspects that Cameron brought up. This was my doubt as well, because we have this transfer of right asset that arises from binding arrangements, and we also have these enforceable right assets that arises from non-binding arrangements that have unilateral enforceability. So at the end of the day, they seem pretty similar, but my question will be specifically for the enforceable right asset. Once again, what the nature of the asset, if it is a transfer of cash or funds, would be different for a transfer of supplies, for instance, because similarly towards what is being commented, the transfer of cash is more easily traceable, verifiable in bank statements. On the other hand, transfer of supplies could be a little bit more challenging, considering that the physical custody of the inventory sometimes is not with the transfer provider. So just to summarize everything, my question will be, is there a specific difference or relevance in terms of the transfer of right asset and the enforceable right asset, and how they differentiate considering the object of the transfer, the inventory or the cash? And thank you once again for responding.
Thank you, Henrique. Any speaker would like to?
I can try to address this one. So both, I guess the enforceable and the other rights are essentially the asset is embodying the direction of how you're using those resources. So it could be directing how you're using cash or directing how you're using inventory. So most of the time we'll look at those as a non-financial asset, so an intangible. But in some cases where you could have, let's say, you're transferring cash and the agreement says, well, your enforcement mechanism comes from the fact that you can get cash back. Or you could have a situation where the other party defaulted and the only enforcement mechanism in that case is you're getting cash back. In those cases, I would say you really have to apply judgment, because it could be a financial asset then, because all you're getting is the right to receive cash. And in some cases where, especially where there's a default, you might actually need to reclassify that transfer right asset to a receivable, because it's you're no longer directing how to use those resources. All you have is a right to collect. So you have to look at the individual terms of the agreement.
Thank you, Edwin. We have here also Henrique Carneiro. Please, Henrique.
Good morning, everyone. First of all, I would like to thank our colleagues from IPSAS, from Task Force. Thank you for your very insightful presentation, for the opportunity to discuss such an important standard. Now I would like to ask a question to Johanna concerning to the nature of the transfer expenses under IPSAS 48. We have noted that some entities often record these expenditures on the regular operating expenses line, such as staff, supplies, and travel, based on the nature of the transfer receipts activities. So in your view, does IPSAS 48 require a separate transfer expense category so that these transactions are clearly distinguished from exchange-based operation expenses? Moreover, should the expense be understood by nature as the transfer itself, or can it still be classified according to the nature of the implementing partner's activities? Thank you for the opportunity.
Thank you. Thank you so much, Tiago and Henrique. I might actually ask Eileen and Edwin to help me on this one. I'm reaching here on the sideline to the standard. I have it here in front of me to check. I think some of it comes down to whether it's from arranging from a binding arrangement or without binding arrangement, because there's when it's a with binding arrangement, there's the disclosure requirements that come in from that. But then if it's from an arrangement without binding arrangement, we still have to include some of the disclosures. And I haven't really thought of it from that perspective of whether there is a whether some entities are currently splitting the expenses that have been incurred by implementing partners to the categories by nature. In UN Women, we have the ability to track it both ways. We have it, by that it's through an implementing partner, but we still know the nature of the expense from the implementing partner onwards. But it's a very, very good question, and I think it's something that we should explicitly capture in our guidance note. But maybe before I jump into what the answer is, we have the technically correct answer from Edwin. Thank you.
Thank you, Hannah.
Yeah. So I'll try to answer this, but it's more of a presentation question. So Eileen might correct me because she's actually working on our presentation CP right now, or consultation paper. But I think in terms of IPSAS 48, IPSAS 48 doesn't really interfere with the presentation requirements of IPSAS 1. So even though it's a transfer expense, you would still have to essentially look through 48 and look at the nature of what the expense was for. So if you're presenting by nature, the fact that you're going through an implementation partner or you're incurring these expenses by yourself directly, I don't think that would really change the nature of the expenses. Now, you could have a situation where you're presenting by function or by individual programs. In that case, you could have differences because the expenses that you're incurring directly would be under a separate program. And in that case, you would have a separation between those expenses and transfer expenses that are through an implementation partner. Eileen, I don't know if you have different thoughts or anything to add.
Not different thoughts, just to echo what Edwin has shared. When the board was developing IPSAS 48, this was a key consideration to say, would there be different presentation disclosure requirements for 48? And the board had decided no, and to refer specifically to what's in IPSAS 1. So IPSAS 1 is obviously still effective at the moment, and they do have the nature versus function presentation approach. And depending on which one you choose, it could also dictate what you have in the disclosures. And so what is actually added is IPSAS 48 has additional disclosure requirements that are more specific to, the judgments that you may have used, any changes in judgments, transfer arrangements, and the various expenses and balances that are related to your transfer expenses. So the two standards do work together, but as Edwin said, it does sort of look through it to point at the presentation requirements in IPSAS 1, which we've had out for about 20 years. But I guess stay tuned with the new the new project that we currently have that will be out for consultation soon.
Excellent. Thank you, Hannah, Edwin, and Aileen. We also have a question here from Nino. If you want to I think it is similar to the first round of questions. It is related to inventories. Maybe I could read it if our speakers want to add anything else. The question is, how should control over inventories held at implementing partner premises be assessed under IPSAS, particularly in cases where an organization does not have physical access to the warehouse and is unable to perform year-end physical counts? Thanks. Any thoughts, additional thoughts on this point?
I can jump in. I think Joanna also covered this in her presentation too, but as Eileen said, like you have to look at IPSAS 48 with other IPSAS and see how it operates. And in this case, you would actually look to IPSAS 12 or inventory and consider whether you have control over these items. I would say that if specifically, if you don't have access to the warehouses and you can't even tell whether they're still there or not, that could be an indication that maybe you have lost control, because it seems like to me this feels like a situation where once you send the inventory items away, you don't really get to see or hear about how they're used again. So to me, I would say that leans towards losing control. But yeah.
Thank you so much, Edwin. Apologies, Tiago, I can't put my hand up to come in, but I think just a supplement, I fully agree with what Edwin had just said, but I think it's also important to consider what is causing the inability to access the warehouse. Would you normally have those rights, but it's in a war zone? And then it might be a different consideration is it a provision against potentially assets that being destroyed because there's a conflict has arisen and you cannot verify them, rather than that normally if you normally would be able to verify. So I think there's different scenarios and different circumstances that needs to be taken into account, and it's also maybe you don't, as an entity, have direct access, but are you able to send somebody else to verify for you? Then you might still be able to control. So I think you have to look into the details as to what type of restrictions you have in place, what other avenues of verification have you got available, and why you might not be able to access it. But I fully agree with Edwin. If it's just that it's now in the hands of somebody else and you no longer can exercise any control, then I think it's quite clear that you don't have an asset anymore. Thank you.
Thank you, Hannah, Edwin. Another question just popped up. Marcelo, do you like to raise your hand and speak up? Please go ahead.
Okay. Hello, everybody. My question is about a scenario with an agency has like a standard general agreement with all implement partners that is complemented with a specific working plan defining service delivery details and so. And so my question is that should the determination of by the binding agreement under IPSAS 48 can be made case by case in this scenario, or can be a general application, consider that this standard agreement is like the same for all the partners?
I can jump in to answer that question and give Edwin a bit of a
Okay.
break there. Because as
Thank you,
mentioned,
Eileen.
enforceability and binding arrangements were a pretty key concept in both 47 and 48. So Edwin and I worked quite closely on this. So definitely a very great question, Marcelo. And I think in reality, for most organizations, a large majority of transactions might be under similar terms and circumstances. But I think there's always going to be cases where various transactions and arrangements are going to be different. So we do definitely encourage assessing arrangements case by case, looking at where some of those facts and circumstances, the terms in the arrangements may differ, and whether or not they may influence the conclusion on whether or not there's two-way enforceability and therefore have a binding arrangement. So they definitely should be assessed case by case. And I think the reality of the UN system and the environment in which the UN operates, I think definitely warrants that, given the number of organizations that are involved. So generally, the standards do recommend and strongly encourage considering the specific terms and circumstances of each arrangement to make that judgment on whether or not it is a binding arrangement. And I think, Enrique, you had a question earlier as well, just about the arbitrary dispute resolution. I was wondering if you still wanted to get an answer on that, or if you've received clarity from earlier.
Yes, if you could, I would appreciate.
Yeah, okay, wonderful, no problem. So I think it is definitely it seemed to be a potential enforcement mechanism that is available, but it doesn't necessarily immediately mean that there's a binding arrangement. And part of that comes back to the binding arrangement definition, because it does require two-way enforceability. And so you will need to look at whether or not there are enforceability mechanisms for both parties regarding the obligations and the rights within the arrangement before you can conclude that it is indeed a binding arrangement. But it is a useful consideration for sure to understand the various enforceability mechanisms available to you to help with that assessment.
Thank you, Eileen. The other Henrique raised his hands. Please, Henrique.
Thank you so much, Thiago. Ellen was just mentioning regarding these aspects of the double enforceability or bilateral enforceability. And my question would be, of course, considering that the enforceability should be assessed not only formally, but as explicitly established in IPSAS 48, also considering substance over form. So considering that, my question would be, if there are specific situations on which there are formal enforceability mechanisms that are established, but they are not used in practice, could we just assume that they do not prevail, considering the substance over form? Or should we interpret that they could be used, they are not being used, but they could be used, so thus we would have enforceability and by extent, a binding arrangement? That would be my question. Thank you so much.
Thank you, Henrique. Please, Eileen.
Sorry, thank you. Too excited to jump in on this. No, thank you. It's a great question, because I think it does show why judgment is so important in this assessment, in understanding the arrangements, because the board was very keen to focus on substance over form. So I think it's more about the latter that you referenced, that it could be, and this is where the judgment piece comes in, looking at more of the potentially the historical considerations between the entities that are involved in the binding or potential binding arrangement, in the transaction itself, and then doing the assessment per se. So just because it is in the arrangement does not mean it's definitely a binding arrangement or an enforceability mechanism. Just because it's not there also does not mean that it is or is not a binding arrangement. So assessing the substance does take a bit of judgment in that case, and really looking at the facts and circumstances regarding the various parties as well as the arrangement itself. That is definitely an area of complexity, and I think that's where the conversations between the various parties, auditors, preparers, can really help to get to the root and understanding whether there is truly enforceability within that arrangement.
Thank you.
Excellent. Henrique Carneiro, is it a follow-up question, please? Go ahead.
If possible, I would like to ask another question for our colleagues from IPSAS.
Sure.
I have a question about the accounting treatment for transfer expense. We noted that IPSAS 48 states that when a binding arrangement is wholly unsatisfied, no asset, no liability or expense should be recognized. My question is whether, even in this situation, the entity should still consider disclosing a contingent liability or a commitment under IPSAS 19 as soon as the agreement is signed.
So I can jump in and take this one. I guess it depends on how material this transaction is. If you have a lot of routine transactions, routine transfer expense transactions, and this is just one transaction, then most likely you would reach the conclusion that it's not material. I'm just saying that, not really knowing about your transactions, but you would have to assess materiality. Normally, if it is a significant or material transaction, we would expect some sort of disclosure, and even if it's even if performance hasn't taken place yet, and that's because this could materially impact the entity once performance takes place. So we would expect some sort of disclosure of this. Yeah.
I see here that, thank you, Edwin. I see here Johanna has a follow-on question on Eileen's response. Please, Johanna.
Thank you so much, Tiago. I can't raise a hand, I think, because I'm a presenter. So if I may just follow on, I'm just fully agree that we can't apply same principles across different entities. There's different financial rules and regulations and different contractual arrangements, and we have to look at the entities differently. We have the principles in the guidance note. But just following on the question of the case-by-case review, so for example, in UN Women, we deal with a lot of civil society organization, and we have standard contractual terms and standard processes and policies in place in the transfer arrangements. In those situations where we are using a standard agreement rather than negotiating every time, do we still have to go through a case-by-case review in each one of those? And I'm asking this because it has huge cost implications, but might not result in, because it becomes then a compliance requirement to demonstrate that we have reviewed every single arrangement when we so we have processes in place for non-standard agreements that do get reviewed every time. But if we really do need to go case by case when we have basically a cookie cutter approach for lack of better term for a transfer arrangement, is that still a requirement from the standard for us to review case by case? Because that might be challenging to implement.
Sure. Great follow-up question, Johanna. And I do apologize if the way I had explained was unclear, because case by case is not meant to say arrangement by arrangement, though often that sometimes can get interpreted that way because of an entity-specific context. So if you think about case by case, it's actually more about the case of facts patterns. So that is related to the specific terms of the arrangement, and that almost becomes its own case. So when there are standard arrangements, that is in a way its own case. So if we look at entities in practice, for example, if you have like 5 or 10 different types of arrangements that you might sign, and 80% of them are all based on one type of standard arrangement with those terms and conditions, that essentially is the fact pattern that you're assessing to then determine what are the accounting implications as a result of applying IPSAS 47 to that specific set of terms and conditions. And so it's not meant to be like IPSAS 47, IPSAS 48 are not meant to be telling entities to assess every single arrangement one by one. It's more actually about looking at the specific package of terms and conditions in each of these arrangements to understand how that might impact the accounting as a result. So in the case of transfer expenses, if you've got one contract or arrangement, those set of terms and conditions that are used by multiple UN entities for a large multitude of your arrangements, that is just a singular assessment essentially, because the terms and circumstances are the same, and then you're applying the accounting requirements accordingly to it. But for those other subset of arrangements where you have different types of terms and conditions, that may require you to do that on a more individual basis for maybe a grouping of 10 arrangements or maybe a single arrangement, depending on whether those terms and conditions are different from the other packages. So case by case is not meant to mean singular arrangements, but that's really up to the entity to determine how many different packages, if you will, of terms and conditions they have for the transactions that they're engaging in. I hope that clarifies and not made that more muddy.
Yeah, I think so. Thank you, Eileen. Thank you, Johanna, for this follow-on question. Cameron raised a follow-on question here as well. You would like to speak up, Cameron? Or
it was just following on from an earlier discussion. I thought that unless a contract was onerous under IPSAS 19, if it's executory, i.e. both parties haven't performed, it's outside the scope of IPSAS 19, so therefore there wouldn't be a contingent liability disclosure. That was my understanding, but I'm happy to stand corrected. Thanks.
Yeah, so that is correct. Before, when I was talking about disclosures, it was more in terms of IPSAS 48 says that, you know, if there are significant transfers, you would talk about the nature. But if strictly looking at IPSAS 19, you wouldn't be in that standard unless it's an owner's contract. So there wouldn't be a contingent liability disclosure, but there could still be other disclosures within IPSAS 48 and IPSAS 1. Yeah.
thank you, Edwin. I don't see any other hands raised. We have a last call. Anyone? Oh, I can see here. Yes, Catherine.
Yeah. Thank you. Now that we have the technical experts, I just thought maybe it would be good for me to just raise this one, which might apply to many UN organizations, because I'm just thinking of a scenario where the UN organization is procuring on behalf of the implementing partner. So that transaction is the UN organization is procuring on behalf of the implementing partner. Does that transaction within the UN organization's books fall under IPSAS 19 or is it 48? Yet we know at the end of the day that expense will result in a transfer expense. That's my understanding. Maybe the technical experts, Edwin or Eileen, could help us understand that.
Thank you, Catherine.
I guess in terms of procuring, so it might depend on whether you control these resources when you initially procure them. Because if you do, I think you would just account for that as a normal acquisition of the inventories, or I guess it could be capital assets as well. And you would apply IPSAS 12 or IPSAS 45. I think if it's more of an administrative issue where you're paying for goods up front, but then you never control the goods, I would almost think that would be a transfer expense, because you're essentially like stepping away from the structure. You're essentially just giving away cash and you're never seeing anything come back to you because the assets go straight to your partners. So that might be under 48. I'm just not familiar with the fact pattern enough to make a clear-cut determination. But I think it really depends on whether you have control of the goods when you initially acquire them.
Excellent. Thank you, Edwin. Thank you, Catherine. Henrique, please go ahead.
Thank you, Thiago. Just a final question to wrap it up. Specifically on situations on which there is an implementation of a binding arrangement, or even a non-binding arrangement with unilateral enforceability. Let's say that the implementing partner provides the service and is expecting the reimbursement per se on this specific situation. So my question would be that sometimes the entity, the transfer provider, has a difficulty to process all of the services that were implemented. So let's say that a service was provided in 2026, but the only time available for the entity to verify if the service was indeed provided was in 2026, the next year. So my question will be related to that. What exactly is the time frame for the triggering event? The time of the service being provided to register the expense, or when the service was processed, let's say, or verified for the transfer provider? Does they have this cutoff issue in between different financial statements, and how could this be addressed? Thank you once again.
Thank you, Enrique. Just to clarify, you mentioned 2026 twice, probably.
Oh, sorry. Yeah. 2035. Yeah.
Okay. Thank you. Anyone would like to jump in?
So I'll give the technical answer would be you should be accounting for the services as they're being provided. Now, whether that's practical or not, oh, I got an AI pop-up. Whether that's practical or not, I can't really say it. It depends on, can you actually have the ability to verify this and to get the information? You could set up other means of monitoring it, but it will really depend on the specific situation and your relationship with the implementing partners. Like they might be able to report to you upfront as they're performing, and you can verify that later. But the ideal question or the ideal answer is, as the services are provided, you would need to account for them.
Yeah, as far as I remember, I think there is also the possibility of estimation. Is that right? Yeah.
Yeah.
Thank you so much. I think we don't have any other hands raised. Well, thank you very much. As we come to the end of this webinar, I would like to sincerely thank everyone for the participation and engagement, especially our speakers, Aileen and Edwin, and also Johanna and Catherine. We had here the possibility to hear from those that had first-hand insight into the standard. We had a good participation and questions, and the opportunity to share our views, our questions. I believe we had a very rich and productive discussion today. Many important questions were raised, many were addressed, and very importantly, the answers also helped generate a new round of reflections and questions for future discussions. From this webinar, we will prepare our work plan for the working group, and then I'm quite sure that we will have many other questions, and that's the idea. We don't want to get only answers from these discussions. We also want to understand what are the main points that we need more discussions, more reflections. It is hard to harmonize more than 20 entities in the UN system. We have a very important work from the UN Task Force on Accounting Standards to do this harmonization process, especially throughout these guidances that are released from time to time when we have new standards. And from the auditor perspective, we also have the challenge to establish communication channels, not only among auditors, because we have more than 10 Supreme Audit institutions auditing the whole UN system, but also communication channel between the auditors and accountants. So the task force and the panel of external auditors. So this workshop is a remarkable milestone in this construction that we are building here, in this communication channel between these two instances. And of course, we had the honor to have here also experts from the IPSAS board, staff, and then we can, from now on, discuss in depth everything that we've seen today. I would like to thank all stakeholders who supported the organization of this webinar, particularly the Brazilian back office based in Brasilia, the Corporate University of Brazil, and the Executive Secretariat of the Board of Auditors. As already shared in the chat, for participants who are interested in receiving a certificate and who have not registered yet, please send an email that is in our chat. Finally, this webinar has been recorded and will remain available for other colleagues who were not able to participate live. Please feel free to share the YouTube link with anyone who you think may benefit from this discussion. Thank you all once again, and I hope this exchange will continue to support the work of our colleagues dealing with IPSAS 48 across the UN system. Thank you so much. Have a good one.
Everyone.
Thank you, everyone.
Thank you, guys.
Thank you.
Thank you, everyone.
Thank you.
Ana Carolina, encerrada a reunião?
Encerrada a reunião. Obrigada, pessoal.
Ok, bom dia, obrigado.
Bom dia.
Obrigada, Ana. Tchau, tchau.